Yes, let's say your only employee is, well, you. You have no other employees. Can you start a 401k plan to put away money for retirement and or lower your taxes? The answer to that is, drum roll please, ladies and gentlemen, yes, you can. Typically, it's called a Uni-K or a Solo K, or specifically, some people just call them a 401k where you have no employees. Yes, the answer is you definitely can. Now, in fact, you can have a 401k just like Boeing or Google or Microsoft. The only difference is you only have one participant, that being the owner. The one participant 401k plan, it's frankly not a new type of plan. It's a traditional 401k plan covering only one employee. These plans have the same rules and regulations as any other 401k plan. There's been a surging interest in these types of plans as a result of what's called the EGTRA tax law change that became effective a long time ago, that being in 2002. The law changed how salary deferral contributions are treated when calculating the maximum deduction limits for contributions to a 401k plan. This change created an opportunity for some people to put away, huge money as far as retirement goes, and also, as I mentioned, lowering tax liability. And by the way, who am I? My name is Kenneth French. I'm with vastsolutionsgroup.com. We do tax and finance utilizing advanced artificial intelligence. Now, it sounds heady. It is, but then again, it truly does add value for the small business owner. I'm an owner, part owner in the entity. I'm also an entrepreneur myself. I also have written quite a bit, do this podcast. The list goes on. Once again, Kenneth French, thanks for taking the time to join us here. The marketing plan aimed at business owners who do not have any employees other than themselves really hit a high, just a couple years ago. Many of the advantages stressed by marketers of these plans vanish if the employer expands the business and hires more employees. No matter what the plan is called, it still must meet the same exact rules as described by the IRS. If employees are hired, they meet eligibility requirements potentially, then they must be included in the plan. It's no longer a, quote, Solo K or Uni-K or whatever the case is. Under prior law, the employer profit sharing and matching contributions were combined with the employee deferral when determining the maximum deduction limit of 25% of employees' compensation. Now, since the tax law changed, the employee deferrals are removed from the deduction limit calculations. Only the employer contributions are limited to less than or equal to 25% of the employee's compensation. The employee deferrals can be made in addition to the employer contributions. Every year, the government does dictate the maximums that can be deferred into a 401k. It's generally around $19,000, $20,000 depending. If an employee is age 50 or older, an extra may be put in. What is that? It's about roughly 20-25%. It's called a catch-up provision. These deferrals can be either pre-tax or, if the plan allows, after-tax contributions. The after-tax deferrals are known as Roth contributions. We've been asked if a participant can defer into the pre-tax deferrals and Roth 401ks. The answer is no, meaning if they can maximize both, the answer is no. There's one limit per person for all types of these elective deferrals. However, the limit can be split into any ratio between the two. Another question we often hear is, how are salary deferrals made between a person who is self-employed or involved in a partnership? The person doesn't usually know for certain what their income will be until the end of the year or later if there's a partnership. The final 401k regs address this issue. The regulations state that a partner or self-employed person's income is deemed available to them on the last day of the taxable year. And since an employee must have a deferral election in place before compensation is available, a self-employed person may not make a cash or deferred election with respect to compensation from a partnership or sole prop taxable year after the last day of the year. If a partnership provides for tax advance payments paid prior to or during the taxable year, that is based on the value of the partner services prior to the date of employment. The individual can defer a portion of these advances even though their compensation has not yet been determined. Now, obviously, if the self-employed person wants to maximize their contribution, they can't do so until the final comp has been determined. When I say comp, obviously I mean compensation. That's okay as long as the election was in place as of the last day of the taxable year. Bottom line, self-employed participants may defer against advances or draws. That's important to note. Keep in mind that at the end of the plan year, the deferral still must be tested as an annual addition to the 415 limits. If the test fails, then the excess amounts deferred would have to be corrected. Now, lastly, employer contributions are not required to be made until the due date of the employer's tax returns plus extensions. Once again, employer contributions are not required to be made until the due date of the employer's tax return plus extensions. Now, so in the case of a sole prop, that is when the 1040 is due, October 15th, if an extension was filed. The IRS is not promoting these types of plans, nor are they saying these plans are bad, by the way. But they will say that, it could be a little bit of a marketing ploy. So just make sure that you are aware as a business owner what is going on. A 401k solo, Unikay, or whatever the case is, it's just a 401k that has no other employees. Now, I'm going to remind you, if there are or is the potential of bringing on employees, got to make sure that you know that they potentially could be part of the plan. Thereby, you potentially wouldn't have some of the same potential advantages or benefits because you have this plan with employees. You have to pass certain tests, and to pass some of these tests, it sometimes can be a burden on the entrepreneur. If you have any questions, give us a call, 888-808-8278, or check us out on the web, www.vastsolutionsgroup.com. Once again, it's Kenneth French. Hopefully this has been of value. We're here for you. Good luck out there, Mr. or Mrs. Entrepreneur.